I'd like to welcome everyone today to the future of health insurance. Right now, we're just going to wait about another 30 to 45 seconds to have a couple other people dial in, and then we will get going. All right, I'm going to get going. It's 2:31. Welcome, everyone. My name is Eric Thompson. My company is Blueback Health. We are a health insurance broker working with small to medium-sized employers here in Connecticut and abroad. Also, I'm the chair of the Healthcare and Life Sciences Council for the Greater New Haven Chamber of Commerce, and I'd like to welcome everyone and also welcome those from the HR Council as part of the chamber. And today's action-packed agenda really is intended to give our audience, you, hopefully a decent baseline of the various products and maybe some of the jargon that's out there. This came about really over the past number of months, both with our phenomenal Healthcare and Life Sciences Council and also audiences in the events that we've been speaking at, where there's so much out there, whether it be individual health insurance or Husky, Medicaid, Medicare, commercial insurance, rate filings, cost of care. So we assembled this great panel today. And so, like I said, our goal is to get you a baseline understanding of these various market segments, products. I'm sure each of you has something that is personal to you or a family member. And so I'm going to jump right into it. One thing we really felt was important is to start with, aside from the insurance side, what about cost of care? What is happening with our hospitals and our providers? Because there's a lot going on there. And so today we're joined by the Connecticut Hospital Association and Paul Kidwell. And Paul, I'm going to turn it right to you. I know you've got some things to go over. And so kindly just introduce yourself, and then let's talk about the landscape on what's happening in our provider community.
Sure. And good afternoon, Eric. Thanks for the invitation and great to be with all of you this afternoon. I'm Paul Kidwell. I'm the Senior Vice President for Policy at the Connecticut Hospital Association. And CHA represents the 27 acute care hospitals across the state. Yale New Haven Hospital and the Yale New Haven Health System are a large member of CHA, and we represent the hospitals in both our advocacy at the state and federal levels, but also in quality improvement, patient safety, and a number of areas of sort of significant importance to the hospital. So maybe a little base setting, and Eric, you sort of led off with like the jargon, and so, and then a little bit of landscape related to how hospitals in the state are doing with sort of the swirl that's happening both nationally at the state level. So as we think about, and this is the sort of the future of health insurance in the state, if we think about how hospitals are reimbursed, we sort of categorize them as government payers and commercial payers, Medicare and Medicaid being the two largest government payers, and then on the sort of commercial side, we do have the fully insured and the self-insured markets. And I think the distinguishing sort of the thing that is important for this group to sort of distinguish between those two is that the federal government sets Medicare provider reimbursement rates. Certainly, we have some influence in commenting, sort of the hospital field comments on those rates every year, but there is no negotiation between hospitals and Medicare in that work. They tell us what they're going to pay us, and we provide services to Medicare beneficiaries, and we get reimbursed. The same is true for the state Medicaid program, and Medicaid is a partnership between the state of Connecticut and the federal government. Those two share in the cost of the program. And similar to Medicare, the state sets provider rates for seeing a Medicaid patient and reimburses at that rate. There's no negotiation between the hospital and the state related to those rates. Just not too far in the weeds, but for all of you to know, hospitals in the state of Connecticut this year pay $820 million in taxes to the state of Connecticut. and those taxes finance a portion of the state's Medicaid contribution um, to keep the Medicaid program going in Connecticut. Obviously, on the other side, on the commercial side, we negotiate contracts with the commercial payers. And I think important for this conversation is the payments that we receive from the government payers, Medicare and Medicaid, do not meet the cost of providing care to those populations. So for Medicaid, it pays about 62 cents on the dollar of cost, and Medicare is about 80 cents on the dollar of cost. It's important because when we go negotiate on the commercial side, in many parts, we are looking to make up the difference, that the sort of loss that we are experiencing on the government payer side. It puts um, pretty enormous pressure on our commercial negotiations to make up the difference in that loss. Um,
And so,
I
Paul,
think,
just
yeah,
to chime in here for the audience. So what we're saying is Medicaid rates are set state level, 62 cents on the dollar for the actual cost of care comes back to the hospitals. When we look at Medicare on a national, that's 80% of the cost of care. And then on the commercial side, we call it the payer side. Those are our individual health insurance policies that we may buy through Access Health CT, or for an employer that may be with a commercial insurer like, a Cigna, a United, an Aetna, and Anthem. Those rates are actually higher than the cost of care because you have to make up for the shortfalls on the others. It's the old rob Peter to pay Paul.
that's right. We call it the cost shift.
Yep.
Right? We are shifting our government costs to the commercial side. Because that's the only place we negotiate rates. We get the rates are set otherwise. And even with all of that, if you look at the last couple of years in the hospital market, on average across the state, 2 years ago, our hospitals had a negative operating margin. Last year, our hospitals had a negative operating margin. So admit a lot of that is on the expense side. So we see the cost of energy, labor, pharmaceuticals rising pretty quickly. We have some ability, obviously, to try to keep that cost pressure down. Most hospitals today use large purchasing organizations to make purchases for certain goods and services. But there are certain costs that we don't have as much chance to control. And if you think about pharmaceuticals, we buy a lot of pharmaceuticals. Uh, uh, um, we certainly try to negotiate good prices for those drugs, but we need those drugs to operate. And so you see pharmaceutical costs as really a significantly increasing part of our expense base. And so that's the pressure really the sector is feeling today, which is you have expenses rising faster than our revenue. And I think as we think about nationally and what are we experiencing collectively in healthcare, that discussion between hospitals and commercial payers is going to be getting harder and harder. And so is that relationship need to be more of less of a negotiation and more of a discussion around the expense side and how do we keep operating? Because what we see happening at the federal level in what we will experience here in Connecticut, that certainly has us concerned, is that we are likely to see, and I know we're going to get a presentation by Access Health a little bit, but to the extent Congress doesn't act and does not advance the advanced premium tax credits, we could see a significant number of individuals losing their commercial insurance through Access Health CT. And then we also, in about a year or so, will likely see a pretty significant decrease in our Medicaid population of people who no longer qualify for Medicaid based on some new federal rules. For a provider like a hospital, that is likely we are likely going to experience a significantly larger amount of uncompensated care. If you didn't know it, there's a federal rule called EMTALA that requires a hospital to treat anyone who walks into the hospital emergency department, regardless of their ability to pay for that care. And so when we see larger spikes in the uninsured, we see a greater number of people seeking care in the emergency department, much of which becomes uncollectible and uncompensated. So sort of globally standing back, that's if you think about how hospitals get paid for the services they provide, and then the additional obligation to provide care to all individuals in the community, regardless of their ability to pay, and that number getting larger, you can sort of see how that conversation between hospitals and commercial payers, what's going to influence those sort of discussions in the couple of years ahead.
Right. So then again, as I always say, if we follow the money, before the Affordable Care Act, we had a much higher percentage of uninsured, which is uncompensated care. Then through Medicaid and subsidies, we carved some of that away so that there at least was some reimbursement on the individual side and the Medicaid side. And now with this disruption, we have uncompensated care, we have fixed rate Medicaid, 62%, we have 80% Medicare of cost. And then that represents then on the employer insurance type side, tremendous pressure to say, this is not going to, we know it's not sustainable, but when our legislators complain about insurance prices, this is the root cause of it, is this cost shift. And so that was wonderful. Thanks, Paul. I think you kind of gave us a great overview on it. What's going on from a legislative and policy standpoint? I know we touched on a few things.
Sure. So a couple, I think, things that as we think about what adds both to the cost of care, but what also just influences care delivery in the state. We have in the state, it's called the cost growth benchmark. It's a spending target that the state sets every year. Both providers, so hospitals, large group practices, and insurance companies are measured annually against that cost growth benchmark. It measures it at Medicare, Medicaid, and commercial. Our state spends a lot of time looking at the commercial growth in the cost in spending growth. And it is a sort of a measure that we think in whole makes sense, but it has to be viewed in whole. If you think about the discussion we just had related to the cost shift, right? Medicaid spending in our state is growing at about 1.5% to 2% a year. But our costs are growing certainly much faster than that. And so our commercial spending is growing much faster than 1.5% a year to make up for that difference. And so it's something that certainly we speak with the legislature on a very frequent basis related to, if we want to set growth targets, how should they be measured and how should they be set? And that conversation has to include what is the cost of actually providing the care, and that sort of downstream effect that then comes upstream to the, like you said, employers as they negotiate those or they look for insurance for their employees. Certainly a couple other items to think about. We are spending a lot of time thinking about the implications of HR1, the One Big Beautiful Bill. That has everything to do with our enrollment in our Medicaid programs and in individuals' access to tax credits to help afford that individual marketplace coverage, and has pretty significant downstream effects on providers. And how do we try to abate some of that uncompensated care that could be coming based on the outcome of that bill. And then I think finally, we have a pretty significant, it's called the Certificate of Need process here in the state of Connecticut. If we want to do anything related to, say, a new service, or there's a hospital acquisition, or there's a merger, et cetera, we need to seek approval from the state of Connecticut for that, to allow for that to happen. That can create a pretty significant administrative piece of work for hospitals pursuing that, and arguably adds to the costs of the service down the line in a place we spend quite a bit of time in. And then I guess finally, workforce. We don't have the workforce we need in Connecticut over the next couple of 10 years to provide the care we do. And we have vacancies up and down the organization. And certainly working with the state to create the pipelines necessary to support the healthcare workforce of the future. So that's a long list, Eric, but those are the things that animate us sort of with the state legislature and the state pretty consistently.
Well, and I appreciate that because, with the chamber and also our Healthcare and Life Sciences Council, which, we're thankful that your colleague Brian's on the council with us because it's critical for us to, understand as best we can and, these issues that are challenging the various, stakeholders in this equation. And it really has to be as best we can, a joint effort. But there are some factors that are just, again, accelerating. And one of them we know when we look at workforce, the administrative burdens that our providers have to either be compliant or do it within the guidelines of the various payers. And payers, just to the audience, that's who's actually processing the claim and issuing the reimbursement. And we talk about commercial payers like the named insurance carriers, but also we have Medicaid and we have Medicare, and those two are paying bills. Paul, I want to thank you, and I know you can hang in for a little bit longer, but then got to move on. And we're going to transition now. When we look at, okay, we just talked about some of the cost of care. We talked about the components of where reimbursements are. Reimbursements impact rates, and those rates go into products that are sold. And so we've got, we talk about Medicaid, we talk about uninsured, we talk about Husky. We're talking about the Access Health CT marketplace. I'm going to turn to John Carbone from Access Health CT. And John, introduce yourself, give us an overview of Access Health CT, and then let's dig into some of the things we just mentioned.
No problem. Thanks, Eric. Appreciate it. Good afternoon, everybody. My name is John Carbone. I'm the Director of Small Group Product Development and Broker Support here at Access Health. Access Health is the official Connecticut state marketplace that was enacted by the Affordable Care Act in 2011. We serve as the main enrollment portal for individual, family, and small businesses. Our main role is to basically allow consumers to shop and enroll into various types of plans, individual, dental, small group, and Husky, and view their eligibility. Our goal is to lower the uninsured rate. That is our complete mission statement here. And we focus on trying to help our consumers, our Connecticut residents, find the best plans and the best products out there. Super focused, as you guys know, I've been talking about the enhanced tax credits that have been coming out. We were just at a meeting today where we had 40 brokers in front of us, and there's a lot of misinformation out there thinking that these tax credits are completely going away. No, they're only the enhanced tax credits for the 400% above of the poverty level, and those are for about 28 to 30,000 of our membership here in Connecticut, which about 85% of our membership gets subsidies from the federal government. It's a little over $1.5 billion from the federal government to help balance out those costs. So our main focus is to kind of simplify and streamline it and get out there with our workforce to help people get into into the different types of products and carriers are out there. As you guys know, two of the carriers we have great business partners with are Connecticut and Anthem. They've both been on since the inception of the ACA. Both of them have a well-balanced split in the membership. We're very happy to have them both on, and they continue to bring great products to the marketplace. There's currently about 22 plans out there, a variety of different plans from HSAs all the way up to gold plans and platinum plans and catastrophic plans. So we have a little bit of everything, and everybody asks us where we kind of fit in this marketplace. I tell everybody we're another tool in the toolbox. We're here to work alongside every single product that's out there. If it's on the exchange, off the exchange, when they call us, especially our small group employers call us and ask us questions through their brokers, if we feel that they're not a good fit and there's a different fit out there, that's the direction we're going to point them in. Because at the end of the day, it's about lowering the uninsured rate, and that's our mission statement here. We also work very closely with Medicaid on making sure we go through all the eligibility for them and guide them into the right direction they need to go, and work with Medicaid and type of Husky plans that are available for them if individual members work out. And I would just want to bring out, as part of my job as a product developer, we're basically just recently, we enrolled on a plan called Business Plus. It houses our ICRA platform, individual coverage health reimbursement arrangement. And we target that for small groups and businesses here in Connecticut to have another opportunity to look for another way to offer a flexible and affordable healthcare coverage here in the state of Connecticut.
So, John, let me unpack a couple things here, help out with the audience. So, when we look at Husky, right, that's a brand name we've had here. For the layman on the call, what is Husky? Is that the Medicaid product for those below 400% of federal poverty?
Yeah, it's up to 138% of the federal poverty level. There's about 3 different types of Husky. There's Husky A, Husky B, Husky C, and Husky D. Husky A is for low-income children, parents, and pregnant women. Husky B is for children in higher-income families, but just don't qualify for Medicaid itself. Husky C is for low-income seniors and individuals with disabilities. And Husky D is for low-income adults without dependents, children, up to 138% of the federal poverty level. So there are a variety of different programs in our platform. Once they put in all that information, we'll kind of guide them in the direction they need to go. And we usually kind of push them over to DSS through our platform, Department of Social Services, and we partner with them to make sure that these individuals have access to be able to enroll.
So then for folks that are, getting Medicaid Husky coverage, they're actually starting out in your, call it, portal or your process with your people.
Correct. They come to accesshealthcc.com and they basically go through our eligibility screen, and it'll either point them towards the individual side if they're eligible for an advanced premium tax credit or not, but they're not eligible for Medicaid. If they're eligible for Medicaid, it will route them to the Medicaid.
So then we have our Medicaid products, and within there, we talked about Husky. And then when we look at advanced premium tax credits, part of the Affordable Care Act said, okay, if someone qualifies for a federal premium subsidy, the marketplaces, Access Health, will certify that individual, and if they qualify for credits, and then if they do, whether they do or don't qualify for credits, the bottom line is Access Health through Connecticut and Anthem have individual health insurance products for individuals and their families that they do buy through Access Health, right?
Correct. So about 85% of our population have get advanced premium tax credits. The other 15% are non-subsidized individuals that just come and purchase an individual health plan. It could be a sole prop, it could be a business owner, it could just be someone who's looking for a gap policy in place just for a period of time in between jobs, and they're just not eligible for any subsidies.
Yep. So sole proprietors, individuals that are, independent consultants, those that are in transition, probably it's not uncommon for, children that are now have aged off their parents' plan, but they're not working in an environment that provides them with any type of plan. And then the importance, which Paul mentioned earlier, when we look at the advanced tax premium credits for those above 400%, right? That's the threshold, 400% of federal poverty. Yeah. We know, on the employer health insurance side, that a number of employers, especially when we look at our not-for-profits in the state, who are not able to afford the cost of, commercial insurance these days, they've been qualifying for these subsidies and getting it through Access Health. And so the importance of the, one big beautiful bill, if those subsidies are not renewed, then they're going to be back looking at saying, will that employer plan be more affordable for me, even though none of it's affordable? But that is the disruption that we in the industry are on, the edge of our seat, because it changes the insurance markets altogether because of risk underwriting and how they set rates. But it also creates potentially a lot of disruption for these folks that, John, you mentioned, or, under your plans now that are, getting a credit or not, or when they're getting a credit, but if it goes away, then all of a sudden it's disruption for them.
Correct, Eric. It's going to create some disruption. If they do go away, they're going to be looking for different avenues. That's going to put additional stress onto the market. going to put additional stress onto the small businesses that are trying to survive with their thin margins. Healthcare probably being number one or number two next to payroll, depending on which version of that, going back and forth. So it is going to be we're kind of planning for both scenarios at Access Health, because that's what we have to do. It just creates a little more work. We're trying to be part of the solution during this, and we're hoping that it does solve itself through, everybody gets together and it does solve itself. But we're planning for both sides.
Okay. And then you mentioned your new product, Business Plus, which when we look at individual coverage reimbursement arrangements, these are not necessarily new, but Access Health has put together a product where a small employer, let's use that as an example, a small employer that either does currently provide health coverage to their employees, or they haven't, but they want to provide the employees with some dollars to purchase product through Access Health. They're able to work with you, that employer, their broker, really, to set up an arrangement where, and I'm gonna spitball this and make an example, but let's say I'm a 8-person auto repair shop and I can't afford to, offer a commercial plan, but I want to give my employees, I'll make up a number, $500 a month. I can get through working with Access Health. My broker could help me set up where I could make $500 available to my employees, that when they make a purchase and you guys certify that they made a health insurance purchase, you can reimburse them. Let's say it's $500, give them that $500 reimbursement towards the cost of their individual health plan. Is that accurate?
Yeah, you're kind of there. You've kind of right on there. The thing we've done different with our Business Plus platform is we've kind of taken the word reimbursement and kind of switched it around. So let me kind of start from the beginning. Back about 14 months ago, we were kind of looking at the market of ICHRA, and we understood that ICHRA was kind of developing and going in a direction. Here in Connecticut, the small group market was dwindling from the fully insured. That's just because there's other products. People were coming on the individual side. They were either going to a partially self-funded product. Again, I always say, find the right tool in the toolbox to help the employer survive through whatever they need to do. ICHRA is going to allow that individual, that employer, to look at their current employees and see, does it make sense to give this individual a contribution, or does it make sense to send this person to the marketplace because they may be eligible for an advanced premium tax credit that may be more substantial than the contribution amount and may be able to purchase a richer plan. I always call the small group market the Wild Wild West when it comes to ICHRA. I know I'm simplifying it. ICHRA is extremely complicated. What we did is we've kind of built in all these regulations, all these compliances, and all the streamline of doing the analysis through our coding tool and our coding portal. And we do not charge our broker community. Every single member that's going to come through our Business Plus platform, we are going to work with a broker. Since taking over the broker side of the fence over the past 3 years, we have grown the broker participation almost up by 30%. I would love for it to be 100%. I feel like brokers bring a great value. Being a broker in the past, bring an incredible value to the market and help guide people to make the right plan decision, because it's important. It's not about picking the cheapest plan. It's about picking the right plan. And that's what our ICHRA platform is going to help our broker community have those conversations with that employer to be able to streamline that process and make the enrollment faster on our Business Plus platform for ICHRA.
That's great. I mean, I think in the end, this new opportunity starts to give us at least another channel to look at and figure out, are we leaving, something on the table relative to subsidies that are available, regardless of where we are today. Also making those individual products through Anthem and Connecticut available. Before we move on, give the audience a quick overview of what Anthem and Connecticut go through when they are setting rates for the next year.
I can give you kind of extremely high level. They really kind of work with our Department of Insurance a lot with that when they're doing the rate settings, but they start early in the beginning of the year as they're going through the process. They work on compiling all their underwriting, all their risks, all their factors, and they work on basically trying to figure out where they need to position themselves in the marketplace to where they can make, again, capitalism, that they're in the business to make money, to make sure, to where they can make a profit on the business, but also bring out a product that's going to be out. So they work very closely with the Department of Insurance, and they start that process. It takes them about 4 to 5 months to go through the negotiations And as you guys have probably seen them, they do hearings, they do public meetings with the Department of Insurance when they ask them questions about their pharmacy, trends and their medical trends. And they try to get them to potentially, figure out if there's a compromise of lowering the rate. They'll start at 28% and 25% and end up down around 21% or 20 or even lower. This year, the rates have been a little higher than usual. And I think that's the fear of what's going to happen in the marketplace, and you have to build into that. So the underwriting team for both carriers have a tough job. They have to kind of balance that between making, a profit to keep the business going, but also being able to provide something affordable to the marketplace.
That's great. Thank you for that. I think when you look at this, as John had mentioned, the insurance carriers then present their initial rate filings with the state Department of Insurance, a number of months before the start of the calendar year. In that underwriting process, they show them, actual, the books on what's happening and, loss ratios and specific plans and membership and shifting membership. And when I say shifting membership, the demographics of the folks that are involved. And that's where, if some of these subsidies go away and then all of a sudden those folks leave these plans, it negatively impacts the pricing realistically. And then also they have to factor in any state passed legislation on mandated coverage. So when we look at the Department of Insurance and the legislature passing mandates on certain things have to be covered, certain things have to be covered at a certain level, that all has costs. And when you look at it across the country, Connecticut's has about the top 3 number of mandates for insurance coverage. So when you are selling insurance in the state of Connecticut, if you're an Anthem or Connecticut as an example, and you're selling a product through Access LTT, you have to cover all of the things that are mandated, those state benefit mandates. And so with that said, that's just kind of how the market has evolved and the pressures that are put on the actual rates. So John, anything else before we kind of move on? We're going to move on now into some of the employer platform products.
No, thank you. I appreciate the time, Eric.
Great. Thank you. So I'm going to take us through, Blueback Health is a company I started back in 2008, but I've been on the carrier underwriting side for a number of years, and then I went into the brokerage side. And we have worked with, small, medium, and national account clients over the years. And what I'd like to do now is give you a baseline of how we are, what we are, working on. And when I say we, the industry. There are different products available and different market segments. And so what I'd like to first talk about is small group. So small group are traditionally employers that are going to be under 51 employees in the state of Connecticut or, outside employees. And when they certify that they are in that market, and we have to work with the various insurance carriers to certify which market segment that employer falls into, we really have a couple different, I call them chassis, a couple different vehicles to ride. One is our fully insured market. You heard that before. So the fully insured market operates similarly to what we just talked about, where the insurance carriers, and primarily today, we only have Anthem and United Healthcare in this fully insured marketplace. So they will go to the Department of Insurance, they'll file their new rates. John, through Access Health, they have, also a group product too. But the bottom line is that those rates are put before public forum. That's where we see a lot of legislators, say it's outrageous and, it's not sustainable, and they're not incorrect. But the reality is that's a very small number of people in the overall state of Connecticut that are getting health coverage. But the fully insured market now, we're traditionally, we're going to have Anthem and United Healthcare. The Affordable Care Act made those rates 1-year age banded. So what does that mean? It means if I'm a family of 5, there's a rate based on my 1-year age, or my age within that band. There's a rate for me, there's a rate for my spouse, and there's a rate for my children. And those rates get added together and can quickly become $3,000 a month as an example. And so the fully insured market, which is now reflective of the Affordable Care Act, it's also reflective of the insurance carriers that said we don't want to sell in that market anymore. Names like Harvard Pilgrim. We had a part of the Affordable Care Act, Healthy CT, which tried to make a go of selling to the small group and failed. Cigna did a product with a company called Oscar, called Cigna Plus Oscar. They came in the market and then they left. Connecticut no longer sells any insurance to small employers as part of their business plan, but also their sale to Molina Healthcare. So we now have two carriers, which actually, this is just my professional opinion, may not be bad for us because now we can better stabilize the risk pool for those employers that can't or are not able to go to an alternate product. And what is that? So in the small group market, we also have what we call level funded. It really is a self-insured plan with budget rates that are paid every month, but the employer has to qualify for that product. It's not readily available through many of the carriers for employers traditionally under 10 employee lives or under 25, depending upon the carrier. And there is some medical underwriting. So we could see that, each year it could be pretty volatile, whereas in the fully insured market, through rate filings, maybe those rates are going up 10, 12, 13%. We could have a swing on level funded that could be, the highest one I have this year is 70%, but I also have some that are 3. And so we have to figure out how to manage that at a time when many of these level funded plans will be saving money over the small group rates that we just talked about, but in some instances not. And when it's not, or it's too small of an employer, then that also represents the risk pool for that fully insured Anthem or United product, which is why I feel like with fewer carriers, we'll have a little bit more rate stability. So I wanted to kind of, give that flavor for the small group where we have really a couple products. There is traditional self-insurance, which, very few employers in the under 51 market are, purchasing because of the additional risks that they have. And then one product that we do have, it's about a year now, going up on year 2, is Connecticut Business Industry Association did roll out their own self-insured product, but it is on, using a level funded financing approach. And there's medical underwriting in that. What does that mean? It means individuals at some companies, depending upon their size, would have to fill out HIPAA compliant confidential medical questionnaires. And then behind the scenes, the underwriters of that risk, the insurance carrier call it, will review that data and then either decide they're going to issue a quote or decline to quote. And at no time do they ever share any of that personal information with, the broker, the employer, and so on. But it is kind of a fork in the road where, a lot of folks will say, gee, that doesn't make me feel that comfortable. And we understand and agree with that. At the same time, it is underwriting a risk at rates, and we're challenged to find the best rates possible. So those are the kind of a product that has come forward over the last number of years. Is the level funded. When we get into the larger group, the 51 plus employer group, what we find is there is some insurance from like probably the employers that are in the 51 to 200 employees. But for the most part, if you then start looking at employers north of a couple hundred employee lives, those really are self-insured plans. And self-insured plans are going to be plans that it could be one of the commercial names that we know, the Anthem, Cigna, Aetna, United, where the employer ultimately finances the claims that come through. So the insurance company will take in the claims, certify them, apply their discounts, apply any plan deductibles, pay the amount of money, and then usually it's a weekly basis, go to that employer and say, hey, this week you owe me 200 grand. Next week you may owe me 400 grand. You may owe me 100 grand. And then throughout the year, kind of the ebb and flow of expense is a better cost structure for that larger employer than being fully insured, where you do pick up some additional premium taxes that are assessed, and then also risk underwriting since you're in a bigger pool. But with self-insurance, there's different requirements, but that's where when we look at who is actually buying insurance, the vast majority of employer plans in the state of Connecticut and throughout the country, it's not insurance. It's a reimbursement model. They rely on, the carriers or third-party administration companies that also have networks and reinsurance. And that's a sophisticated process that we go through as brokers where there's a lot of data that's involved. But at the end of the day, that's how those plans are getting financed. And their rates tend to be a little bit more stable because they have a defined risk pool. So if you're an employer, and I'm going to go up market a little, if you're an employer that says it's 1,000 employees and you don't have high turnover, your claim costs and expected costs over the years will be fairly stable. Whereas if we now go into the small group market or the individual market that we talked about earlier, you could have a big swing on the people and their health conditions that are in that risk pool, which puts pressure on the rates. And so I went pretty high level on that. What we have done now too is within that self-insured market, the carriers I mentioned, do sell stop loss. Stop loss is kind of that, it is reinsurance. So for example, maybe I buy a policy that if I have an individual in a given year that has more than $100,000 in expenses, that reinsurance company, the stop loss carrier, will pay for that claim over 100,000. So if it's a $500,000 claim, I as the employer finance the first 100, and then the reinsurance company pays the remaining 400. And so within the commercial carriers, they sell that product traditionally baked into their employers that they sell product to. But then when we take the fork in the road, there's a number of third-party administrators out there that look and act like the carriers that I mentioned, where they're processing claims, they're giving, clinical review, they're bringing in pharmacy, mental health services, telemedicine, all of these things that are part of a health plan. But then they also have to make sure that that employer has reinsurance, because the average employer, depending upon where it, taps out on size, once you get up into tens of thousands of employees, they're generally not buying reinsurance. But with that said, one thing that the market has done over the last number of years, and this is not new, is looked at kind of captive reinsurance. And this has been a prevalent product in the workers' comp, where employers might come together and say, we're going to share risk. We're going to kind of look and act like an insurance company, share our claim costs. And if we have surpluses, we'll get them back. But with that said, there's a lot of different variants in that product with captive. But what I wanted to do today is bring Marty Kilcourse in, because there's a lot of misunderstanding and miscommunication on what captive reinsurance is and self-insurance plans. It's not uncommon for me to have conversations every couple of weeks with a CFO or an owner of a company who some broker has come in and said, gee, you're really missing the boat if you're not part of a captive. It's a sales tactic. At the end of the day, it gets to risk underwriting, and is there a viable product for them? So Marty, I'm going to turn to you. Give me a little overview of your company, and then let's get people into what is, self-insurance with captive reinsurance.
Sure. Eric, thank you. And I think I have a really good slide that shows where the risk lays and where the risk transfer is for a traditional fully insured plan, traditional stop loss, and then where a captive sits. So thank you everyone for joining today. My name is Marty Kilcourse. I'm with Captive Resources. We are a captive consultant located out of Chicago. We have a very large presence, as Eric said. Captives have been prevalent in the workers' comp and commercial liability and commercial auto space for many years. And we were the company that sort of started that in the early 80s. But there's also a large shift in transition within the market for health insurance for fully insured groups of all sizes, looking for relief from the fully insured market, and self-insurance we feel is the best way to go. So I'd like to show just a couple slides here. There are some rabbit holes we can go down pretty quickly when it comes to this product, but I want to make sure that we give everyone just a little bit of an update in sort of what to look for and what to think about. And if it's something you think is worth pursuing in the future, reach out to Eric, reach out to your contacts here at the chamber, and they will be happy to set up some time. So let me see if my screen wants to work here.
Yep, we can see it.
You see it? Perfect. When we talk about groups that want to go fully insured, and we talk about move from fully insured to self-funding, what is going on right now with your current dilemma that you're in, what we call kicking the can down the road? And what happens is it's the crushing cost trade-off, right? It's you as an employer group are asking for more control, more data, and more options. People want more options. And Eric did a very good job of pointing out that the fully insured market here in Connecticut for employer groups to go to has shrunk drastically in the last 10 years. What were there? 6, 7, 8 options at one point, and now it's really watered down to basically 2. So from a buyer's choice, whether it be you're going to buy a TV, a car, or health benefits for your employees in your company, you want offerings that meet where you're at. And where you are at right now is you have to trade it off. The trade-off is for HR folks that are on the line, keeping the plan viable and attractive, or making it too rich and it becomes too financially liable to the company. Or if you water the plan down, it's more of a financial palette for the company, then are you risking the employee traction and retention of the actual plan? And in the end, the fully insured carrier is going to win either way. They have a good year, you have a good year, they're still going to hit you with a renewal. If you have a bad year, you expect that to renewal to be even worse. And really on this one, the third bullet here, there's the really big thing: no data, no decisions. You may have heard, you can't manage what you can't measure. And Eric and I have this conversation all the time when he has a client or a prospect that he's talking to and they complain, an employer complains, and I say that very kindly. They're complaining because the response is, all the data I get is just a spend number. I'm only seeing my medical spend. I'm only seeing my pharmacy spend or RX spend. Where are my claims coming from? What can I do to fix what I'm looking at here? I can't keep up with this. And that's what I always hear from groups when they say, we can't continue to do this, so why should we consider moving self-funded? And I'll talk about that. It's really, you're going to get your data as an individual group, and then you can make some actionable changes. And the last one there, going from fully insured to self-funded, you're not on an island alone. There's a lot of people and a lot of entities in place to help you. So if you're sitting here saying, you know what, I'm a fully insured group, or I work for a company that's maybe 40, 50, 60, 70 employees, we don't think we can probably make that shift to self-funded. I can guarantee you there are groups half your size that are considering making that move right now today. And this is a great slide. So where is the growth in the self-funded market? Again, I just mentioned if you're a smaller mid-market group under 100 enrolled, between, we'll say 50 and 100, like, is there anybody else doing this? This is from 2000 to 2024, and this is the percentage of growth for mid-sized employers within self-funding. Now, that 1,000 plus to the right, and then the 299, you see large numbers there. I've been doing this for many, many years. I almost don't want to say, but it's coming up on 25 years. And when I first started doing, in this role, in this business, selling stop loss, a group that was 150, 100 enrolled, it was tough for them to go self-funded. You didn't have a TPA, carriers didn't want to quote it. And now we have groups that are 40 enrolled asking if there is an out from the fully insured market. Why is that? I mentioned the data. The brain power, the talent from an HR and an ownership and a C-suite level moves down market. And when they move down market, they bring that knowledge base with them. And then the other pressure is, and Eric pointed this out already, you only have 2 options, a handful of options in the fully insured market. So when you start as an employer group to think, where else can I go? There's got to be an out. There's got to be an off-ramp from the highway. And one of the things we always talk about with groups that want to move into self-funding from the fully insured market is control and what you should expect as you become a self-funded group. And when we talk about this to groups that want to join a captive program, these are some of the this is the sort of the progression, the 1, 2, 3, 4. It's very much a crawl, walk, run philosophy. When we talk to a fully insured group and they want to move into self-funding, the first thing that you're going to gain on that first number 1 bullet, that's your access to data and analytics piece. And if you want to consider captive resources, that's great. But if you are just sitting here thinking, you know what, we've been considering going self-funding before, we're trying to figure out some of the benefits, the pros, if you're going to do your pro-con piece of paper, one of the pros you want to put down immediately is the access to data. Once you get your data, which is literally where your claim spend is coming from your employee population, then you can sit down with someone like Eric and say, what am I seeing? What am I looking at? And with captive resources specifically, if a group decides to join one of our captive programs, which on my side of the house right now is 9, we have 9 programs. Every single one of our captives comes with a data analytics platform. So we have a group join, their data from their TPA gets sent over to the analytics group. They actually turn this raw numbers into a digestible and very attractive portal to look at. And it tells you where your claim spend is. And that's part of that transparency piece. Okay, so Marty, I've got my data. It's in a real nice, pretty website. I can see what it's telling me. What do I do then? And then that's when we step over one block to the O2, the number 2 there. Cost containment solutions, cost containment vendors. When you need them, use them. Where do you get them from? You can get them from your captive consultant, your broker like Eric, very good. They have very good relationships. Eric has very good relationships in the state with the vendors that are available. And it's usually an a la carte menu. So much like going to the grocery store, you don't walk down the candy aisle and buy all of it. You're going and looking for one particular piece of candy. You want the Kit Kat bar, you go look for the Kit Kat bar. When you need a vendor for a particular solution, you can then engage that vendor. And what is a vendor? Marty, you're talking about these cost containment solutions. What is a vendor? Very simply put, let's talk about pharmacy spend. As we've heard the gentleman from the CHA talk about the pharmacy spend is really high. If you watch the news for the last 5 to 10 years, you know that pharmaceutical costs are going up. In the fully insured space, there's no lever for you to pull. If you have someone that is a employee or a dependent within your company that is on a high cost drug, when you move into the self-funding space, you have a whole option open up to you in regards to patient assistance programs. There are outside third-party vendors available to come in and possibly remedy the situation. There is a big thing right now is international pharmaceutical acquisition, mainly through Canada or Europe. And what that does for a self-funded employer who is paying their own claims, that reduces the cost of the drug. You could take a $37,000 to $40,000 a month drug and turn it into $5,000, $8,000, or $10,000, which, as you can quickly do the math, that's a massive savings for an employer group. It's a very real world example. And then when we talk about captives, when we look at 3 and 4, sharing the ideas with a like-minded business partner, this is one of the big things when we talk to anyone that's interested in joining one of our programs or our captive programs. Our captives are small. Our largest one is about 300 employer groups. What that means is when you go to a board meeting, you're an owner of a captive. A captive is an insurance company that's owned by the people that is insuring, or is insuring the people that own it, whichever you want to say. When you go to one of these board meetings, you meet other employer groups who are of the like minds. Could be from someone from a completely different area in the country, could have a completely different SIC code, completely different industry, but you all share the same idea, which is you want more data and want more control and want more transparency over your health benefit plan, because you're trying to do more for your employees and the company at the same time. And this is some of the spots where we like to talk to folks and say, you know who's in the water with you. If you're taking on water, your ship is sinking. Reach out to some of the other folks in the captive program, because I bet they can be able to help you out. They've already had the same issue and they can guide you to the remedy to your situation. And then the last piece there, when you join a captive program, you get to see your financial data. You also get to see the insurance company that's insuring you. And it's a very empowering thing, especially for the C-suite, for anyone here that's a C-suite member or someone from HR who has to report. And the CFO is always going to be asking about numbers. You can show them some very clear data on how you as an employer group are running, and it's some actionable steps that you are planning to take to help control that cost. So it empowers HR as well from that control and engagement aspect. So I've talked about a couple things, what we're talking about, the vendor partners and things like that. When you go into a self-funded environment, a lot of groups that we talk to don't understand what their fully insured carrier brings to the table for them. Like, okay, I'm insured with Anthem, Cigna, Aetna, CVS, UHC. I just send them the bill every month, but I don't really understand what they do for me. On the right side, when you look under the foundational pieces here where it says TPA, PBM, and data analytics, the TPA is a third-party administrator, and Eric mentioned that. So you think about an Anthem or one of those carriers I mentioned, what they're bringing to the table for you are these three pieces. The TPA is claim adjudication. So a fully insured carrier is adjudicating all the claims, and then they're bringing their network to it. That's the access piece. So for an employer group, it's important, right? The HR team wants to have the access, so the employees and their dependents, they know where to go. These carriers also bring a pharmacy benefit manager to the table as well. Where do I go to get my scripts? CVS, you go to Rite Aid, Walgreens, local pharmacy, Target, wherever you go, that's the access that's provided. When you move into the self-funding space, you think about that foundation, those foundational pieces are now broken apart, and you have more control as an employer group about implementing and placing basically those pieces. So the third-party administrators will be the ones that adjudicate all of your claims. They'll also bring the network access piece. That's the hospitals, and that is obviously the doctor's offices and the imaging offices. The PBM, which is the pharmacy benefit manager, that is a very important piece of going self-funded. That's going to be the mechanism in which the drugs are basically charged and accessed. They're still going to be able to go to a CVS, they'll still be able to go to Rite Aid and all the places they're going, but that claim is going to flow back now through what we call a PBM. Very important piece about this self-insured, this chassis, the PBM, they are the ones who are going to return you the rebates. The pharmaceutical rebates from the manufacturers now in a fully insured market stop at the carrier. In the self-insured market, they come back to you as the group. And then the data analytics piece, which I sort of already mentioned, now you get to actually see where your employees and the dependents are generating your claim spend from. And that helps you do something in the yellow line above it. Those are the risk control pieces. Also, as I mentioned, the cost containment. So cardiometabolics big, virtual primary care, telemedicine took off during COVID and it's not left. I think it's a great avenue for groups to put in place. Cancer, centers of excellence, musculoskeletal. And if you notice all the way on the right side, it says TBD. TBD is, what do you need next? Like, what do you need that you don't know you might need now? Could it be something that's, the musculoskeletals there? Do you need diabetic management? Because you see diabetic management claims are kicking up and you need to engage an outside vendor. So as you need those things in the yellow rim, you get to pull them in as an employer group and then engage those cost containment vendors as needed. So it's a very powerful way to get some of the spend down and under control.
So the reality is when we look at this, Marty, if you go back to that slide,
Yeah.
So for the audience, I talked about, the named carriers. They do all of this, okay? They offer products that have all of this. Then for alternatives in the market, we have these other plans that operate and look the same. It's just there's a little bit more of what we call the unbundling, where you might be able to make some real-time decisions each year on, let's say a pharmacy benefit manager. Maybe there's bigger rebates through a different pharmacy benefit manager, or maybe there's a center of excellence. A center of excellence is when you have someone with a critical need, and we know that a specific hospital, let's say in the country, does the best job of doing heart transplants, as an example. Mm-hmm. Then all of a sudden that center of excellence says to that member, that individual, we'd like for you to go to, and I'm making this up, Baylor Medical Center, because they do the most heart transplants. And again, I'm making that up, so don't connect the two, but they do the most number of heart transplants. They have the highest survival rate. They have the lowest rate of infection. And if you go in this program and you're in Connecticut, then we'll pay for the transportation for you to go. We'll pay for your family members to be housed there while you're in this serious situation, and the outcome is going to be better for everyone. And that's where they call it excellence, because it really is saying, okay, you have a serious need, and where is the best place for you to go based on data and results, and not just, oh, Dr. Smith is a great doctor. Why? Well, my neighbor said he was great. So that's where these analytics come into play. And so what Marty's talking about is the deeper we dive, it's not because an employer aspires to know all of these details about their folks. It's ultimately companies want to take that data and say, what can we do about it? How can we better improve the outcomes and also lower our costs. And I'll use, for example, infusion therapy. A lot of folks go to hospital settings for infusion. It could be anywhere from 2 to 2.5, 3 times more expensive than if you actually had the company come to your house and give you your infusion. Now, people make their decisions. The system allows for that, but that's a real life situation where it's like, okay, does it make sense for me to be able to, have that option, or should I pay more if I can have equal or better outcome at a lot lower cost? And that's where we struggle with all of these various components, and it's complicated, obviously, as we're going through this. And then when we look at the captive side, we use this term pretty loosely, but it really is captive reinsurance. It could be anywhere from 10 to 15 to 30% of a health plan. For that reinsurance. And then the question becomes, if you can make that a more efficient product, which is really insurance 101, it's reimbursing someone for certain expenses, then that's another way to get a better cost structure for something that is not really determining, clinical outcomes. It's simply financing, higher cost situations. And so that's where I wanted to unpack with Marty, what is a captive? A captive is a reinsurance pool with employers. There are different pools. He mentioned, he has a bunch of different risk pools. And it's something that has to always be looked at and considered at a time when there's a lot of options out here. And that's where we continue to reinforce with folks, you can't just, not pursue this and not be aligned with your broker in that regard. And so as we move off this, Marty, is there anything else that you wanted to talk about before we get over to Shannon?
No, I think that's good. I'd like to, we talked earlier, there's a lot of rabbit holes we could go down. If anyone has any questions or would like to hear more from them, please reach out to the chamber, let Eric know. I'd love to get out there and meet you and let you know what we do and what some of the options are. I appreciate the time today.
Wonderful. Thanks, Marty. So to rewind quickly, we started with Paul from Connecticut Hospital Association talking about the challenges in the state relative to healthcare financing. Medicaid, the lowest level of reimbursements, fixed, can't negotiate. Medicare is the second, in the middle of reimbursement at maybe about 82 cents on the dollar of what actually costs to deliver that care. Then commercial insurance, which is part of what Marty just talked about, where we are buying a network. It is an employer plan. The reimbursement rates that are tied to that plan traditionally are based off of negotiations between the insurance companies that are offering that network, Cigna, Aetna, Anthem, and the employer that's buying that plan. We talked about individual health insurance through Access Health and the Connecticut and the Anthem product, and then how the subsidies play into that. I talked a little bit about what happens in that small group market, the under 51, both fully insured, level funded. In that population, we have people that are Medicare eligible. And that's where we're going next. And the same way with large group, when we look at employers over 51 lives, we start to get into self-insured. We start to, we get in under that, but we really start to, be involved when that employer is a couple hundred lives in self-insurance, which includes captive reinsurance. And along the way, we always have individuals in our workforce that are at employers or that are, former employees or family members that have Medicare or are going to need Medicare. And so I want to turn to Shannon from Anthem, and we're going to unpack Medicare a little bit. And Shannon's also part of our Healthcare and Life Sciences Council. So Shannon, I really appreciate you joining us today.
Sure. Let's see. Let's get my slide deck shared. Can you see my slides?
Yes.
Perfect. Okay, so so I'm Shannon Duncanson. I'm the regional sales manager at Anthem, and I work with about probably just over 1,500 agents here in the state of Connecticut that their primary focus is selling Medicare to individuals. So you probably have seen on the news and on the the TV, radio stations that our annual enrollment time, AEP, started yesterday. So we are right in the thick of our Medicare season. And we'll talk a little bit about that. But just a couple questions here. We ask, okay, who's eligible for Medicare? Let's start with that. There's many different ways to become eligible for Medicare. Number one, you must be a permanent U.S. resident of at least 5 years in a row. Number two, you or your spouse must have worked or paid into Social Security taxes at least 10 years. Okay, so that's in order to qualify for Part A, which we'll get into it, but Part A is free, but also it will allow you to purchase Part B when the time is right. So, you could have a scenario where it's a husband and wife, for example, the wife has stayed home all those years. Well, if the spouse has worked enough quarters to become eligible, that will allow, or I'm sorry, if the husband, for example, worked X amount of quarters and they're eligible, that's going to allow their spouse to also be eligible. So there's lots of unique situations here. The third example is what most of us think of is, oh, once I turn 65, I'm eligible for Medicare. And that is correct. Once you turn 65, you have the choice to either come off your group plan if you're still working and go on Medicare, or you may just decide at 65, I'm going to retire and I'm just going to go on Medicare, and that's fine. But also, don't forget, we have a lot of people who are under 65, and they're also eligible for Medicare for the simple fact if they have a disability. Okay, so once again, there's lots of scenarios, and having done this for several years, no scenario is ever the same. The one thing I love about Medicare specifically is it truly is an individual plan. So many times, for me, for example, I get insurance through my employer's plan, and I pick my plan, and then my husband and 2 children have to come along with that plan also. But once you get into the Medicare world, it's a little bit different, because if my husband and I retire, I can enroll in one type of a Medicare plan with carrier X, and my husband, it may be better for him to enroll with carrier Y. So once again, it's an individual solution for members. All right, let's get back to the next page. Oh, we're not working here. Let's see.
So then as you're switching on that, Shannon, I think one of the key things here is when an employee is working at a company and still working past age 65, they are not forced to come off that employer plan. However, they should, in my opinion, look a few months before they turn 65 to say, should I go on Medicare? Is that a better alternative than staying on the employer plan? When we look at the cost of the insurance and my out-of-pocket expenses and potentially some penalties down the road, which I know you're going to talk about for late sign up.
So that's a perfect example. That's a perfect segue, because I'll chime in, and I use my poor mom as an example all the time here. So my mom was working, and she worked until she was age 75. She loved working, loved her job. She paid very little for her health insurance through her employer. So for her, it made sense to stay on her employer plan. Okay. But some people, it might make sense to, okay, I'm 65, I'm eligible, I can enroll in Part A, which is hospital insurance. That's free. You don't pay anything for that as long as you've had your 10 years in. Part B is for doctor services, okay, physicians, so lab work, going to your primary care doctor. That's Part B. Part B, there is a premium for that. And typically Part B, right now it's about $185 a month. And that automatically comes out of your Social Security check. Okay, so if you're on Social Security, if you decide to prolong and not collect Social Security, but you still want to go onto Medicare, you can. You'll just have to set up automatic payments to pay for that Part B. But, we have Part A, Part B. A lot of people have heard about that. When someone enrolls in Part A and B, they're going to get what they call, I call it the red, white, and blue card. And if you're on Medicare A or B, you'll know what I'm talking about. But that signifies that you've enrolled in Part A and B, okay? And that's wonderful, but there's more to it. So what does that mean? So A and B will cover about 80% of the bill. Okay, so now you're responsible for about 20% of the hospital and Part B services, and there's no out-of-pocket maximum on Part A and B. And that's important because I'm going to talk about other plans that do have out-of-pocket maximums. So A and B, you can enroll in that. They're going to cover about 80% of the plan. But what are you going to do to cover yourself for the other 20% of the bills? That's where you're going to step back and you're going to say, okay, do I enroll in a Medicare supplemental plan? Do I enroll in with a Medicare supplemental plan that's hospital coverage, medical coverage, but you'll also need to purchase a Part D. You'll need to sign up for a prescription plan, okay? And a lot of times your employer will let you know, okay, you have a credible, your current employer plan is credible. As long as you have a credible Part D or prescription plan with your employer, you're not going to have any penalties when you switch over to Medicare and enroll in a Part D prescription plan. Okay, that's important to know because these penalties, if you don't enroll when you're supposed to, Part D, you can be paying 1% of the premium in a, what am I going to say? In a penalty, 1% per month that you've not had a credible plan. So that could certainly grow and be expensive. So very important. So a Medicare supplemental plan, what that's going to do is if Part A or Part B cover the item, Medicare supplement's going to pick it up. And they're either going to, depending on what type of a plan you enroll in, it's going to be either 100% paid for, or you're going to have a copay of like $20, for example, for an office visit. Okay. But what it's doing is the Medicare supplement is going to follow and cover whatever A and B cover. Okay. And that's going to protect you with the 20%. Okay. And then, like I said, Medicare supplemental plan does not cover prescriptions. So you'll need to purchase a Part D program where you can get prescription coverage, but also Part C. Part C is Medicare Advantage. So use those words interchangeable.
Hey, Shannon, can I stop you for a second? I
Yes.
want to back up a little
Yeah.
because now we just hit the fork in the road. So when I am someone that is eligible, and again, I always encourage, in advance of when you become eligible, I don't know if you have a magic number. Is it 3 months before I turn 65? What do you think
That's my next slide, Eric.
So go back to the prior slide. But I wanted to just explain before you go into Medicare Advantage, if I decide to buy what we call a traditional Medicare plan, I get hospital insurance Part A at no cost. I sign up for Part B, which is about $185 a month, which will be indexed if I am still earning income and could go upwards of $500. Forget
Yes.
about the limits, but it gets indexed if I'm a high income earner.
Yes.
But I pay that. Then if I want to cover what A and B is not covering, either in a partial coverage or all of my exposure, I can go buy from Anthem and others a Medicare supplement plan, which I call it kind of a wrap around it.
Yes.
And then the fourth leg of the stool is you have to have prescription coverage. And the Part D came out a number of years ago, heavily subsidized by the federal government. There are $0 plans out there, but what I always like to do is say to folks, let's follow the money, step back for a second. I don't pay for Part A. Let's say I'm paying $185 for Part B. Let's say a supplement plan, I'll make up a number, $300 just to make it easy. But
That's
it's in
fair.
that range, 250 to 400 range, depending upon the plan and the carrier. But let's say it's 300, so now up to $485. And then the prescription drug plans could be anywhere from close to a zero up to maybe 70 or $80 a month. So now all of a sudden, Eric just painted a picture that you might be looking at $550 for a traditional Medicare plan. If I now and I'm pretty much almost everything's going to be covered. I'll have some copays maybe on my prescriptions, but I don't have a big deductible. I don't have what we call the out-of-pocket limit that could be $8,000. Whereas if I look at my employer plan, am I paying $550 a month to be on that plan? And if I am doing that, or even if I'm not, how much is my employer giving me for a deductible? Because most of our plans now are these high deductible health plans, a $3,000, a $4,000, a $5,000 deductible. And so, so that's a comparative of, does this four-legged stool make sense for me? If I'm not working anymore, then that's option A. Option B is, okay, I'm going to go buy a Medicare Advantage plan, which is a replacement to the four-legged stool that we talked about. So let's then take that and say, okay, I've got this four-legged stool, but if I don't want that and I want to go to Medicare Advantage, what is it and why would I consider it?
Okay, so Medicare Advantage, the difference between that. So a Medicare supplemental plan, you can go anywhere that they accept Medicare assignment. Any provider that accepts Medicare assignment with a Medicare supplemental plan. With Medicare Advantage, it works very similar to your employer plan. So you have a network of providers. So that's where, I always say, it's important to meet with an agent because the agent's going to look up to see, are your doctors all in the network? Because whether you're with, Anthem, United, Aetna, Molina, wherever, Care Partners, we all have different networks. So looking to see where your doctors are, that's the number one thing you're going to want to look at to see if the Medicare Advantage plan is for you. Now, the Medicare Advantage plan, a lot of those plans have been zero premium in the past. We're now looking at the premiums coming out, and this is where a lot is changing in the Medicare world. So now we've got plans on the Medicare Advantage side that are maybe $30 to $75 per month. So before where they were no premium, but at the end of the day, like Eric said, you're balancing the coverage and what you're paying with your employer plan and trying to measure, does it make sense to go on Medicare if I'm still working? Okay, but the Medicare Advantage is everything all in one. So I'm going to talk a lot of letters here. So Medicare Advantage is inclusive of A, B, and D. So it's going to cover your hospital, your medical, and your Part D coverage. And so we call it Part C. So a little confusing out there, but Medicare Advantage is Part C, where therefore it's everything wrapped up in a bow. You don't need to have two separate things. You don't need to have a Medicare Part D prescription plan over here with your supplemental. So, but once again, it's working within a network and you have copays and cost shares for office visits, hospitals, and everything, a lot of other things. So I like to think of it now, MedSup is I pay now and I really don't have to worry much about the claims later. Medicare Advantage Part C, I'm not paying a lot per month. I'm paying much less, but I'm going to pay when I use the plan. So it's kind of like a pay now or pay later, if that makes sense.
Well, and I think when we look at this, and these letters, by the way, are government issued letters. So when we look at A, B, D, C, all of that, that's not Anthem speaking. That is, Medicare. But with that said, both options work really well together, I'll be honest. So when we look at, okay, Eric said a four-legged stool, the claim processing is really seamless because electronically behind the scenes, all of these entities are connected and they're processing the claims and checking with each other electronically. So So just know if you're not there yet, it sounds complicated. It actually works pretty well. Um, and then the part C is, okay, I'm going to go to a less expensive premium option. Let Anthem, as an example, be my sole provider of coverage. And I might have some more out-of-pocket exposure than the program I just talked to you about. But the bottom line is, if it's the right fit, then that's what I would look to figure out. And that 1,500 plus agents that Shannon mentioned earlier, those are the folks that are trained and educated on this to really give the customer the right answer, because it is complicated. And I always say you really should be with an agent that is a Medicare agent. So let's keep going, Shannon. I know we're coming up on 351.
Yeah. So this is a real, I love that this slide probably speaks for itself. So when someone's getting ready to turn 65, they can start the process with, you have to, I'm sorry, I should have said, you need to be an A and B before you can enroll in a MedSup or a Medicare Advantage plan. Okay, so you can start. So 65, that's everybody's initial enrollment period, where 65 you can enroll. Some people may want to prolong it, but if you're going to go into Medicare at 65, then you can start the process 3 months before. Okay, and you really have 7 months to enroll in this program, because you've got to submit some paperwork to Social Security to enroll in Part B. Once you're enrolled in Part B and you get your card, then you can enroll in your Medicare plan. So that's why we say start it as soon as 3 months before your 65th birthday. Then you have the month of your 65th birthday, but you also have 3 months after your 65th birthday to get enrolled. And once you complete the paperwork and you enroll, you'll be effective the first of the month following your paperwork being submitted.
And I think when you look at this, as you're coming up on, age 65, finding your agent and working with them, there's a lot, behind the scenes when you look at where am I going to live in the future, potentially, how do I get my care now? There's a lot of, information that will be taken into account as you look at that agent ultimately giving you some options to consider. And so that's why I always say to any of our employer clients that have folks that are coming up on Medicare eligibility, start early.
Mm-hmm.
Okay.
Yes, absolutely. Yeah. So once again, this is just covering the basic coverage, Part A, Part B. That's what everybody needs to know. Like I said, Part A, you can automatically enroll, no fee. Part B, you're going to pay for that. But this is just a recap of Medicare and the different options. So you're either going to do a MedSup along with Part B, Part D as in dog, or you're going to enroll in the Part C, which is going to include A, B, and D. Okay.
Mm-hmm.
So, and the important thing is, quick scenario, how do you know, do I go on to a MedSup or do I go on to Medicare Advantage? Okay. There's the annual enrollment time going on right now, October 15th to December 7th, where just like with your employer plan, you can change every year. So I'll use the example. My mother was going on Medicare in September when she finally retired, and she was having a hip replacement. So she sat down with the agent, and the agent said to her, "You're probably better off spending the $300 per month for September, October, November, December. Because if she was to enroll in a Part C, a Medicare Advantage plan, she would have had copays per day while she was in the hospital and rehab. And that could be $400 a day. The plans are all different. So for my mother, it made sense in September to enroll in a MedSup plan, a supplemental plan, and then she switched and went to a Medicare Advantage plan for January. Okay, because she was going to be done and she really didn't have anything going on. But at the end of the day, this is what the agent will say. What do you have going on? We only know what we know. We can't help emergencies. But I always try to reassure people, you can change every year. The unique thing about Connecticut is we're one of 4 states that have guarantee issue. So enrolling in a MedSup plan, it's not medically underwritten. which is very important. And like I said, we just talked about working after 65. My mother, she retired at 75. And that was fine. She got a letter from her employer that said she has credible coverage. She retired. She took that letter to her Medicare agent, and her Medicare agent sat down and talked with her about the best option for her at that time to go into. And for her, because she was having a hip replacement, she went on the med sup. But you could always, you have that choice.
And I think looking at this slide, we're coming up on the 4 o'clock cutoff. When we look at this working after 65, one thing we do as a broker in the employer market, when we have companies, and this is a federal law relative to if you're under 20 employee lives or more than 20 employee lives. What I'll simply say here is if you're an employer over 20 lives, 20 or more, then Medicare is secondary to that commercial insurance. And so the two would coordinate. Behind the scenes, we have to interact with the federal government through your insurance company to have, files sent relative to knowing that, hey, this person is part of this company and they're over they're 20 or more. So then, Aetna, Anthem, whatever pays primary. If we have a smaller employer with fewer than 20 employees, then that individual that's still working and over 65 does have to sign up for Medicare A and B to avoid a late penalty down the road. And that's where when we look at, Shannon mentioned credible coverage. I won't go into that. The bottom line is that is in alignment with your employer plan, and your employer should know from their broker whether or not the current plan is credible. And that's simply tied to, is there going to be a late sign-up penalty because it's not a plan that provides a certain value of benefits? Great. Shannon, did you have anything else, or are we ready to wrap up?
No, I think that was it.
Okay. Well, thank you, and good luck with open enrollment with I don't know how you multiply yourself to be dealing with 1,500 different agents, but I know Anthem has the resources. So as we bring this to a close, I want to truly thank everyone today, both our wonderful panelists and all the work that you guys do. Everyone's committed to helping folks without a doubt. And then also I want to thank anyone that did dial in today or is listening to this on a recording. The goal was simply to give you a little bit of an insight on these various products and also some of the challenges that we're seeing. And it is overwhelming with content. And I think that for the Healthcare and Life Sciences Council, one thing we're expecting to bring throughout the rest of this year and into next year is maybe a little bit more vertical on each of these products so that we can really unpack something that, for example, if it's Medicare, that could be something that could take up an hour if we did it right versus, giving Shannon a few minutes to get through it. So with that said, I hope everyone did get some value out of this today. I'd like to thank the Chamber for running it, recording it, and sending the link out to everyone for where this will reside. With that, have a wonderful evening and a wonderful weekend that's coming up.
Thank you.